360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Thanks for tuning into Profit Insights. I'm your host, Niraj Shah. It's very rare that you encounter a scenario wherein whales, in market parlance, the big fish, have to succumb to the might of market fundamentals. If anything, there are whales in the past that have made the market move to them in rare instances. But our guest today has written a note, which is very topical, by the way, this morning. It's on oil. His title is Note, Oily Moily, a Long-Term Tailwind, and says that oil has seen an end of an era. And then it goes on to describe why that is the case and how to, more importantly, play what he believes is a structural change. Our guest today is Nirav Sheth of Emkay. And Nirav, great having you. Thanks for taking the time out.
Thank you for calling me in, Niraj. It's always a pleasure to be here.
Likewise. Always great to have you. Now, Nirav, I think you are saying that it's an end of an era for oil because you believe that the oil fundamentals are deteriorating sharply, and this time around, that might be structural in nature. Could you explain that?
Two things. Niraj, I'm making, so I think finally the price of any commodity is a function of demand and supply, right? So I don't think that we are seeing anything new as far as the oil demand is concerned, right? So if you look at, let's say, OECD as a basket, then even pre-pandemic, the consumption growth was declining. So the fact that your oil intensity as a percentage of GDP consumption tends to decline as you become richer is a very well-known fact. What is obviously the new kid on the block is we have seen a significant decline in the oil consumption by China. Part of that could be inventory, running down the inventory and stuff like that. But we do know for sure that if I take a 3-5 year perspective, then there is big unwinding in China excesses, you want to call that way. So that's the demand part. I think, by and large, if you look at the last 4-5 years, the price of the oil has been essentially set by supply, which is essentially OPEC plus, which obviously was trying to control and trying to ensure that the supply of the oil is in sync with the market demands, which means that the equilibrium price of the oil was higher to that extent. I would argue that you are very, very close to this sort of arrangement breaking down. And the key point, Niraj, that I'm making in the note is that there is a price that you are paying every time you are holding back the production from the markets. That price is loss of market share. So if you look at OPEC today, the market share in 2012 was roughly about 62%. That is less than 50% today. Think of it, that another 50% of the guys are actually benefiting from the compliant, reduction in production quotas run by OPEC. It is something like, think about the cement industry in India. It is saying that, top two players are curtailing their capacity and the small cap companies are outpacing the volume growth rate. They are also benefiting from higher profit growth rate. And now the larger guys have got less than 50% market share. This is not sustainable. You have to start defending the market share. You have to protect the NPV of your oil field that you've got. It's just a question of time. So I think two things. A, the big unwinding that is happening in China, which is long-term structural in nature. They have got the fastest line of sight to electrification. And secondly, the fact that OPEC Plus sort of losing control because of the laissez-faire approach, largely by the US shale industry.
Got it. So, okay, so on the supply side, Nirav, you are saying that traditionally supply has reacted very strongly to demand destruction and shored up prices. We've seen it all through the last 15, 20 years. You believe the template could be different going ahead?
Absolutely. Absolutely. So unless and the oil goes to $40, in which case obviously OPEC will have to react very, very strongly. But why would you want to keep the profits of the industry up, and you are the only guys who are paying the price for that, right?
Right.
Cartelization works beautifully if all the participants are a part of that game. You cannot assume that half of the guys are going to carry the weight of this cutting production quotas, and the other half are going to have a free ride. Life doesn't work that way.
Viewers, in his note, Nirav mentions that in the most recent Joint Ministerial Monitoring Committee meeting, which is a part of the OPEC meeting, I presume, the coalition, which is OPEC, indicated that the production plan could be paused or reversed depending on market conditions. But OPEC stayed put despite underwhelming oil demand, which, according to him, is a signal towards a pivot towards defending the market share. And Nirav's note says that this defense of the market share, oil prices would be the casualty, which is why I heard him say that, if the oil prices were to go unnaturally lower at $40 or thereabouts, whatever the number may be, then you have maybe a change of scenario. But otherwise, this is the template. Now, Nirav, that is the supply side. You reckon demand, not just now, but even otherwise is issue, because we know there are some economic issues right now around the world, but you believe that demand for oil structurally will be lower in the next few quarters/years?
So two things. A, we see what is happening in China, and there is no incremental news around that. It is an information, let's assume, that which is well discounted. What has happened, obviously, is the fact that now we are trying to figure out whether there's going to be a soft landing, hard landing, no landing in US. I am personally not too bearish in terms of how US is going to play out. But obviously, all of us are dependent upon, or let's say all of us are data dependent. So there's an element of uncertainty that is obviously weighing on the oil prices right now. I am not too worried about that. But certainly, I think even otherwise, in a normal scenario, and when I say normal scenario is that your global GDP grows at about 2.5%. In that case, your oil will grow at about 1%. It could be flattish depending upon the efficiency. And when you're talking about 1%, is about 1 million barrels a year, right? So, today OPEC is sitting on spare capacity of 6 million barrels. So you are flush with oil, is the point I'm trying to make. All of us want to eventually go towards an oil-free world, right? Because that is a mandate, whether it is 35, 2040, 155. You got structural headwinds as far as the demand growth is concerned. And the fact that your economies by and large are now, consuming far less oil per unit of GDP than what you were doing 10 years back, 15 years back. I would stick to my view that we are done with, having any bullish forecast on oil. You could have some supply shocks and, periodic geopolitical disruptions that can create short spikes. That's about it.
Got it. Okay. And in the note they mention, and there's that China's economic mess and rapid electrification present structural headwinds. There's a wonderful chart that we've pulled out as well, which shows how Chinese oil demand has been, if anything, in a range, but has been coming off relative to what you've seen in the whole of last decade. And therein lies the other big problem for oil, that demand by and large due to electrification and otherwise is largely coming low. So, Nirav, in such a scenario then, before we get to the how to bet or how to benefit from this, I want to understand from you, there is also an element of what lower oil prices, maybe a slower China, maybe a soft landing in the US does to inflationary pressures. So there is an indirect impact of all of this and a direct impact of all of this on how do people place their bets. What would you want to start off with?
We generally underestimate the impact that oil has got in terms of inflationary pressures because, it is, first of all, it's a $3.5 trillion annualized industry, only oil, right? And then it filters into petrochemicals, chemicals, there is a substitution effect to other energy, commodities like coal, man-made fibers, textiles, electricity, transportation. You think of it. There is no doubt that if oil prices stay high enough or they stay long enough, there is a significant impact on the cost structure of the global economy. Which means that, for importers like India, right, this is a blessing in disguise, right? So the fact that our RBI has done a very good job, our core inflation is south of 3%. We are running at about 2.9%. And if we have this tailwind of subdued commodity prices, including oil, I think you broadly won the battle against inflation, which means that if you try to take a lens and look at the next 5 years, then probably our inflation is trending down, my interest rates are trending down, my current account deficit is will be heading towards a neutralist situation. The Indian macros can't get better, Niraj. And I think that markets are forward looking, right? So we always get very skeptical. We get always very concerned because the markets are running ahead of the earnings. And that is intuitively, very discomforting for all the investors, including us. But markets do what they are supposed to do. They'll sniff these things out, right? And I believe that, the decks for India are very, very well set. And I'm not even making the case for being very bullish on the Indian markets. I'm talking about the economy right now. The markets can time correct. They can correct 10% tomorrow. That is the nature of the game. Between now and the next 5 years and next 8 years, I think that you'll have a far, far better outlook on the global macros, on the Indian market, and on the corporate profits. That I feel very confident about.
Okay, so let's then therefore talk about the indirect way before we talk about the direct way. The direct way, some of the plays have been discovered, but I would love to understand because you've written very well about the direct plays as well, but the indirect plays. So lower inflation, maybe in the immediate term with the Fed cutting and inflation coming lower, RBI forced to cut rates, or RBI cuts rates, not forced to cut, but goes and cut rates, whatever, what have you. How do you play that theme?
So very clearly, the benefits, like I said, is banks. And so my view, right, and I may be wrong. So I think for the size of Indian economy, right, if my consumer debt is running at about, I think close to about 40% of the GDP, we are nowhere as compared to other economies. And if you do it, if you got a good stack that we talk about, which is, the jam stack, and therefore your ability to underwrite credit is reasonably good. I think that what we need is a pickup in credit growth, and it's going to happen. Not so much from retail, which obviously is increasing at about 15-16%. But I think the corporate loans, which are down by close to 15% of the GDP over the last decade or so, I think that is going to come back very strongly. And, we are looking at the financing, the renewables in data centers and stuff like that. So there's a new set of industries that is going to come up, right, which is going to be debt hungry. And therefore, I believe that the estimates for credit growth for the analysts, including ourselves, are lower than how they are likely to play out over the next 2 or 3 years. And which means that there will be a reset of valuations as well. So purely on risk return parameters, I think banks stand out. You obviously want to bet on banks which are slightly more tilting towards corporates, are willing to underwrite risk on the corporate side. There is an element of higher risk when it comes to project financing and stuff like that. Some of the banks are good at that, which is also very fine. But I remain constructive on that space. Credit is holding up well, economy is holding up well. You don't start getting credit loss just because you've done well for the last number of years. You need to see pockets of excesses. Yeah. You need to see pockets of loose underwriting skills. I see none of that. right? Which means that,
No,
quite
Nirav,
okay in terms of.
but Nirav, the problem has not been of that. I mean, if anything, the naysayers on the banking bets are actually saying flagging of very low credit growth and the fact that corporates now don't have banks as the last.
India, or even if you're looking at overseas market, right? You've got a very, very restricted set of people who can access, you need to have AA rating or a AAA rating, right? And that's a problem. When I'm talking about the Indian companies, when I'm talking about the manufacturing capex coming back, it's not only Adani's and the Reliance, right? Because they have to nurture an entire set of ecosystem, right? You're going to make transformer. Who's going to make transformer oil? Who's going to make copper coils and stuff like that? So someone has to go and underwrite the credit over there, right? And that has to come because we meet so many companies and entrepreneurs are by and large bullish in terms of the outlook for the next 5 and 7 years, and they're willing to bet as well on that. So to me, that part of the credit is going to come back. Some of the banks will be proactive in terms of underwriting the risk. Some of them will follow over a period of time. I would like to believe that some of the PSU banks would be more forthcoming in terms of trying to tap this kind of credit opportunities. But yeah, to answer your question, I am very bullish on the outlook of the credit growth. And, we talked about this earlier. I don't think the constraint to credit growth is deposits in any way. RBI has to create primary liquidity. It is not that you put money into equity markets and it gets out of deposits. If someone is buying equity, someone is selling equity, and but deposits are just flowing from one pocket to another pocket. It does nothing to the overall deposits in the country.
So where have deposits gone? I mean, if deposits are not going to banks, where is that money going? I mean, that's an argument people make, that if stake sales have happened and promoters have gotten out, and that money which could have gone into deposits have gone into the equity markets per se. You don't agree with that?
Absolutely not. I mean, just try and take this chain of reaction, right? So let's say, for example, I am buying a share, right? So I'm drawing down my deposits, right? So someone else is selling it. He's going the money. He's going to put that money into the markets. A promoter is selling, right? In that case, the credit will get transferred to the promoters. Absolute new deposits in the system can only be created through money multiplier. So it is credit that creates deposits. It is not deposits that create credit, and I'm very clear about this.
Okay, fair call. Okay, so you are constructive on select band of financial services, ones which will effectively cater to the infra corporate capex cycle, and you're betting on banks and NBFCs willing to pick up this credit. Well, viewers, the graphics are on your screen, but SBI, REC, PFC are their favored bets, Nirav's favored bets, and ICICI Bank's inherent DNA of the project financing will probably help them from this surge as well. Now, the next bet, Nirav, again on your note, is the most obvious and the most powerful investment hypothesis in your view: oil marketing companies. If oil demand by and large is going lower, you think it is still some time away, this demand destruction in India, and therefore OMCs will have a period of growth?
You will have a period of growth, but more importantly, what is happening? Two things. First of all, obviously, your valuations are sort of discounted by, the regulatory intervention, if you want to call that, right? And regulatory intervention increases when you got an upside risk to the oil, not when you got a downside risk to the oil. So first of all, if the markets were to come to terms about the view on oil prices that we have, for example, which means that will be low for longer, the need for regulatory intervention goes down, number one. Which means that you are slightly and therefore, you will be far more equipped to take a long-term view on earning visibility. So there is a significant chance of valuation expansion that happens. Secondly, that is from an investment perspective. But if you now look at what is going to happen, for example, some of the things that we have mentioned, that if you look at the marketing margins, which is where bulk of the money is being made by OMCs, the marketing margins are roughly about 4.5 rupees a litre when you look at quarter one. If you look at July, August, and September, today they are at 15 rupees. Now, please understand, it was something like HPCL. If I remember the figures right, every 1 rupee will increase close to about operating profit by 6,000 crores.
Mm-hmm.
So that is a delta, right? Now, obviously, at some point of time, if you are making excessive profits on the marketing side. There'll be some amount of pass on that will happen. Government may increase the excise duties. But there is no doubt that if we look at normalized earnings over the next 2, 3, 4 years, the OMCs are trading cheaply. And you have to look at this in the context of what the markets are trading at and what the market valuations are.
Okay. One of the lines, Nirav, that you put. So, okay, I buy your point that there is, through multiple vectors, the probability of earnings growth being very strong. I want to understand two lines, which I loved on your note. So, one of them is, I want to understand, you've said that OMCs with a lower degree of refined integration will have higher leverage to earnings from lower crude and refining margins. Can you explain that, please?
So, see what happens is a bit of technicals, but usually if you got $50 of oil, then you add refining of $5, you add marketing of $10. So the OMC companies will make $10 on if the crude is priced at $50. What is happening right now is that you can make higher marketing margins even if the refining margins are lower, right? Because your end price today is fixed. So what you want is that if you are bullish on the marketing spread, then you want to have companies which are low on refining and high on marketing, right? So you ideally want to have lower refining margins, a lower intensity of refining profits to your overall profits. Don't get confused. Only thing that you need to keep in mind is that if someone is buying refined products from outside and selling, is going to make more profits then someone is going to refine his own products and sell.
Got it. So I think the note viewers mentions that HPCL in that case could be a player that could be doing this business model, if you will. So in some sense benefiting from this. The other question, Nirav, just one quick follow-up there, is the on OMCs, and then we move on to some others, is that you believe that there is a near-term high earnings tailwind as well, because you use the term blowout. In terms of quarter 2, quarter 3 numbers. So you believe there is an immediacy to earnings uptick for oil marketing companies?
No, of course. I think you will see a serious level of earnings upgrade. I think markets are slightly worried about the fact that, you're close to Marasi elections and therefore there will be some price cuts. But if you just do the numbers, even if you have to assume that the price cuts will come, there is a significant leeway to earnings upgrade that we feel very confident about.
Okay, so constructive on OMCs, constructive on select banks. Nirav, you may be more constructive on one versus the others, but you believe OMCs by and large as a basket could do well, right? If I'm not wrong.
Absolutely.
Okay.
Yeah.
Okay. Now, what about some of the other oil derivatives? So either oil upstream, because there's a big case being built, right, for oil upstream being undervalued and the valuations have not gone up so much per se, and that India may oil demand abhi bhi theek hai, so the oil upstream could also do well. So what happens to oil upstream in such a scenario of oil pricing?
So very clearly, the first delta is obviously negative because the fact is that, I think if I remember right, then ONGC earnings are mostly neutral from $72 and above. Anything less than $70 is when the earnings starts getting downgraded, to which I believe there is a reasonable level of risk. So, to me, the line of least resistance for oil is down.
Down.
You can usually get the direction right. You will never get the magnitude right.
Agreed.
Right?
Agreed.
So I would essentially stay away from upstream right now. If I've got a strong conviction that oil is heading down, why would I even look at upstream companies?
Got it. What about some of the other beneficiaries? Because company after company, when oil prices go up, say paint companies or tire companies come in and say, okay, hey, we don't get impacted too much because there is a lagged effect, we hedge, so on and so forth. Is the same argument therefore on the way down as well? Or do you believe structurally it's possible that some of these companies can go to a higher plane of EBITDA margins?
I think they can certainly over a period of time get to a higher plane of EBITDA margins, but that is not the way I look at it. See, what essentially means that let's say for example, if my oil prices don't do anything for the next several years, what it essentially means that I may choose not to increase my operating margins, but keep my prices flat, right? Which means that because of sheer income elasticity, I'll gain through volume. So either way, I'll get an operating leverage, right? Whether it is through pricing gains, whether it is through cost deflation, or it is simply because of the fact that, I'm passing on the pricing gains, but I'm gaining through volumes. Essentially, one way to think about this is that the entire cost structure will get deflated. just think about it, right? So you had yesterday oil prices which are down at 4.5%, 5%. I had no idea because I was writing the note in the morning. But even coal India has dropped today by 3.5%, which is logical because if oil goes down, then coal prices have to go down simply because of the fact that they are substitute to each other in terms of generating energy or generating electricity.
Got it. Okay. But okay, fine. But so Nirav, you are effectively saying that for all the other businesses, you would look at the industry structure and the bottom-up stories, and not simply use crude as the vex for figuring out whether investment into that sector, be it paints, tires, what have you, comes into play, right? That would be a fair assessment.
Of course, 110%. So this is a top-down view. This obviously has to sink in with your assessment of valuation, earnings, competitive scenario, stuff like that.
Got it. So, viewers, the Emkay view from Nirav Sheth, end of an era of higher oil prices, and it's a long-term tailwind for multiple things because it permeates into multiple areas of an economy. Nirav, fantastic talking to you today. Thanks so much for taking the time out and speaking to us.
Thank you so much for having me, Niraj. Thank you.
The pleasure was ours, and viewers, thanks for